Hello, everyone, and welcome back to the Yield Curve Trader channel, your daily source for macroeconomics, markets, and global financial insights. Today, we're breaking down three major macro developments shaping markets right now. The failure of U.S.-Iran peace talks, the start of the IMF and World Bank spring meetings, and a major shift in interest rate expectations. Let's get into it. What we can call the Islamabad stalemate. Over the weekend, high-stakes peace talks between the United States and Iran failed to produce a deal. Negotiations broke down over key issues. The U.S. pushed for strict limits on Iran's nuclear program, while Iran demanded full sanctions relief. Neither side backed down. Following the failed talks, tensions escalated quickly. The United States moved forward with a naval blockade of Iranian ports, and Iran responded with strong warnings of retaliation. Former President Donald Trump added to the tension, stating that the U.S. would take a hard-line approach if Iran refuses to comply. So where does this leave us? Not in full escalation, but in a very fragile environment. Markets are now pricing in prolonged geopolitical risk. The IMF and World Bank spring meetings have officially begun, and the tone is already cautious. Global policymakers are gathering at a time when the economic outlook is becoming more uncertain. The key concern? The impact of the Iran conflict on global growth. Higher energy prices, disrupted trade, and tightening financial conditions are all starting to weigh on the global economy. We are likely to see downward revisions to growth forecasts, especially if oil prices remain elevated. The Federal Reserve narrative has changed. Higher for longer is now the base case. After last Friday's CPI report, which showed inflation rising 0.9% in a single month, markets have dramatically adjusted expectations. At the start of the year, traders were pricing in around 60 basis points of rate cuts for 2026. As of today, that number has dropped to essentially zero. No cuts are now expected this year, and we're already seeing the impact. U.S. Treasury yields are moving higher across the curve. Investors are preparing for the next key data point, the Producer Price Index, expected tomorrow. If wholesale inflation also comes in strong, that could further reinforce the higher-for-longer narrative. Now let's talk about earnings, because Q1 earnings season is officially kicking off, led by the major banks and financial institutions. Goldman Sachs reported this morning. Headline numbers came in strong, beating top-line expectations. But the stock is down around 4% in pre-market trading. And that tells you everything about the current market environment. The key issue was a miss in the FICC division, fixed income, currencies, and commodities. This is important because FICC is where banks typically benefit from volatility. But right now, even the largest institutions are struggling to navigate extreme moves in energy and currency markets. So what should you expect from the rest of earnings season? First, expect elevated volatility across financial stocks. Second, watch for pressure in trading divisions tied to commodities and FX. And third, pay close attention to forward guidance. Banks will give us real-time insight into how businesses and consumers are reacting to higher energy prices, tighter financial conditions, and geopolitical uncertainty. In many ways, this earnings season will act as a reality check for the broader economy. And before we wrap up, here are two key events to watch later today. At 2 p.m. Greenwich Mean Time, watch for updates on the official status of the U.S. blockade of Iranian ports. Any tactical change here will have an immediate impact on oil prices. And throughout the day, several Federal Reserve officials are scheduled to speak, including Barr and Barkin. Listen carefully for any mention of the neutral rate, or even early signals that rate hikes could be back on the table if energy-driven inflation continues to rise. So let's wrap it all together. We are in a market environment defined by three forces: geopolitics, inflation, and central bank policy.